Right. Hello and welcome to Portfolio Briefings. My name is Mona Dole. I'm the Deputy Editor of Portfolio Institutional. And with me today, I've got David Stewart. David is a CIO at British Airways Pensions. Welcome and thanks for joining us today, David.
Mona, good afternoon. Thanks for the opportunity.
Right. It's a pleasure to have you here. And you've joined fairly recently, actually, just before the lockdown. So how's it been for you?
It's been interesting, Mona. I joined in mid-February. By the end of February, we were running sort of full trial runs of working from home as it became obvious that we're about to move into that scenario. I became officially CIO at the start of March, and almost my first action as a CIO was to send everybody home. So at least I got the chance to be in the same office with them for a few weeks. It's been interesting. It was only laterally it occurred to me that if you shorted the market every time I make a major job move, you probably actually sort of have quite a good performance record by now. I joined ADIA just before the Asian debt crisis and long-term capital management blow up in the late 90s. I launched my first fund, the Pellegrin Fund, weeks before 9/11, and now this. So I think my job moves tend to be a leading performance indicator of some sort.
Should come with a warning then, your appointment. How's it been settling in a team?
I've settled in with the team sort of reasonably well. Yeah, I have to say that my deputy CIO Johnson Hill, who joined from Nest, he actually joined after the lockdown started, so he hasn't even had a working day in the office yet. Thanks to video conferencing, we know what it looks like, but we don't know if he's 5'2" or 6'2". So we'll find out that when we get back into a more normal environment, I guess.
Mm-hmm. Interesting, yeah. And so you're actually covering two different schemes at British Airways Pensions. There's APS and there's NAPS.
Yeah. So APS, the Airways Pension Scheme, is the is the older of the two, and now that's a pretty mature fund now. So it's the funding levels up at 98, 99%, and interest and inflation hedges are both up in the very high 90s as well. That's a mature portfolio, as you'd expect. It's mainly gilts and credit, with private equity alternatives, real assets very much in runoff. The other scheme, the New Airways Pension Scheme, the APS scheme, the portfolio that we manage is about £2 billion. The New Airways Pension Scheme is much less mature. That's about a £20 billion portfolio, 85% funded, but the hedge ratios there are obviously much lower.
Okay.
It has, I guess, a more conventional asset allocation, whatever that means. But it's about a third equities at this point in time. 8% property, 4% in alternatives, for example.
Okay, and with the new scheme, you've Newish. That's closed in 2018 as well, right? And since then, you've gradually cut down equity exposure. Is that something you continue planning to do, or are you looking to invest? So far, it's gone in favor of bonds mainly, it seems.
So the NAP scheme, it is working to a long-term journey plan, so that there are time-based, market-based de-risking triggers. So we are progressively deallocating from growth assets into matching assets over time, and that's done on a fairly regular basis.
And that's generally fixed income, or would you also look at alternatives?
It's generally fixed income. I think one of the more interesting things we're doing is the diversified liquid income portfolio, the DII portfolio, where we're leveraging internal competencies to source assets, particularly through our property team, acting opportunistically within fixed income markets, and that's part of our matching strategy. And the ability to use assets like that within our matching strategy, I think is a key part of the strategy going forward. I think as schemes mature, it's not just the asset allocation, it's the investment philosophy, the investment mindset switches from traditional growth assets more towards matching assets. And that's as I say, that's a philosophy, that's a mindset, as much as it is if you like, a simple reallocation. And that was one of the key things that John, our deputy CIO, joined when he joined from Nest. Previously, he was with PPF. He's there to help us with that, if you like, sort of cultural shift from growth assets towards matching assets. The work that he's doing with the DII portfolio is a key part of that.
And APS is obviously a very different situation because there's no allocation to equities whatsoever, and but I noticed quite a significant allocation to real assets. Can you tell me more about that?
Well, the real assets, the private equities, alternatives, they're all very much in runoff. It looks high because obviously when we did the buy-in last year before, that took a chunk of the fixed income out, and so it looks like the allocation to alternatives and real assets and things trebled over the last couple of years. But in actual fact, that's simply as a result of the buy-in, and therefore the active portfolio that we're managing. All those asset classes are in runoff.
Okay, so that makes sense, of course. So NAPS is then the main, in a way, where the bulk of the assets is being invested. I think almost close to 20 billion, right? So,
yes, that's right.
And so can you tell me a bit more how both portfolios have been affected by the recent market volatility that we've seen at the beginning of the year?
They're affected, definitely. Were they affected badly? No. I think that as a very widely diversified long-term investor, when we're buying things, it's very much on a buy and hold rather than a trading basis anyway. And I think that quality bias across credit, across equities, as well as the allocations into private markets, kept things relatively stable. And of course, the bounce back was so quick that it didn't look like a sort of a huge deal anyway. We were concerned about the property portfolio, the credit portfolio, given what's happening in the wider market. But I think our experience with those two asset classes in particular has actually been really quite it's been very resilient. I think our property team and our credit team have both done a really good job in building a genuinely resilient portfolio there.
Okay, good. I suppose for property, it's quite hard to tell the long-term impact in a way because it's relatively illiquid. But still,
it is. But I think if you look at where there's been capital impairments, I think value is already showing that, and where there's been impairment in rental collection, that's been a very significant feature across the market, and we have been, I think, really quite resilient on both those metrics.
Okay. Is that also due to the sectors that your property investments are in? Because some sectors are obviously benefiting almost, like logistics or warehouses or so in commercial
The,
property?
there's definitely been a benefit from sector allocation. I mean, Paul and the team had made decisions several years ago to not be in shopping centres and things like that. And they've got a very distinctive strategy, which has generated outstanding returns over, I was going to say multiple years, multiple decades that they've been with the team.
Okay. And as we talk a bit more about like a more structural challenge, there's been a lot of talk about risks of rising inflation. And you're obviously quite heavily invested in fixed income, as are many DB pension schemes. How do you think, how likely is it that inflation could pick up? And are you concerned about that at all?
God knows. I mean, people have been, people who know a lot more about it than me have been forecasting an increase in inflation for many years now, and we haven't seen it. Will it come back at some point? Of course it will, but it's unclear what will cause it to come back now that wouldn't have caused it to come back 5 years ago or 10 years ago. So that's a huge open question that I certainly sort of aren't clever enough to be able to give you any sort of answer to.
But you are anyway. You have a focus on liability hedging, so do you feel relatively confident that at least some effect of that could be cushioned off by your LDI strategy then?
Oh, definitely, yeah, absolutely.
Yeah. And then I guess it depends on which way it goes. It's very hard to tell at the moment, isn't it? It could be deflation, it could be inflation.
It could be, or it could be both. It will be both inevitably at some point or other. But I think that I think it becomes increasingly clear that the environment we're in now, in many ways, isn't too different to the one we're in before this started. I know that sort of last year seems like a completely different time, but so ever since the GFC in 2008, 2009, there's been worries about the distortions in capital markets. There's been worries about where sustainable economic growth would come from. And I think those underlying concerns, those structural issues, they've been accentuated in the last few months, and what's been done in the last few months will have repercussions for years to come. But it hasn't changed the direction on anything. And I guess that's one of my more fundamental concerns as a long-term investor. That I mean, growth to an economy is what education is to society overall. It's the silver bullet, it's the panacea. With it, everything becomes possible, at least in theory. Without it, everything becomes just that bit more difficult. And some things become absolutely impossible, and that hasn't changed. So all the huge rescue efforts that have been put in place, thankfully, in days and weeks rather than the months and years we saw in the GFC, that's been great. But that's about survival. That's not about a new leg up in growth potential for the global economy. So that hasn't changed. As far as the disruption that we're seeing in financial markets, that we've seen over the last 10 years. I mean, for years we've been saying that if negative real interest rates, huge government borrowing, and state-financed rigging of financial markets was the route to economic nirvana, it had probably been discovered some time ago. It's much more likely that we're simply putting in place a whole new bunch of distortions and misallocations. That hasn't changed either. What's been done in the last few months has simply amped up those dynamics as well. So you know, I don't think things have become any clearer or any easier for long-term investors with respect to that.
With that in mind, is it actually, it's the question if we actually will see those kind of levels of growth that people are hoping for, that modern capitalist economy would need, because in a way it's like cumulative growth, and what 10% growth 100 years ago looks very different to 10% growth today, isn't it? So how long can that be sustained? That's at the risk of going slightly off topic, but
well, you know, there will be new sources of growth. You know, there's no question about that. I mean, look, my background is as an equity PM, so I've got sort of, I'm not one of these bond guys who's manic depressive. I'm an equity PM, so I'm hardwired for optimism. You know, and it's always wrong to bet against human ingenuity and ambition, and so where there's human ingenuity, human ambition, there's always going to be growth. So there will be growth there, whether that's in the green economy, whether that's in medicine or technology. And as active investors, that obviously concerns us more than the overall level, because we, as active investors, we focus on areas of growth rather than the wider economy. But clearly government policy and social issues are driven by the wider economy, not by one or two areas, and I think we've got to be cognizant of that and the challenges that's going to pose.
Okay, so the interesting point is now going to be to find out which those new growth areas are going to be, and which areas are going to benefit from the changing world that we are seeing, isn't it?
Yeah, and I guess one of the challenges is in a low growth, low investment return world, accessing those high growth areas is probably not going to be cheap, and that's perhaps one of the key challenges facing investors.
Yeah, equity markets certainly seem quite pricey at the moment, doesn't it?
I don't remember a time when they didn't seem pricey and people felt good. They're only cheap when people are feeling terribly depressed about prospects.
And so with that in mind, are you planning any changes? I mean, I'm aware you're a long-term investor, but are you planning any changes to your asset allocation?
The changes that we make to asset allocation is more in line with the journey plan than any short-term views on capital markets. It's not your question, but I think it's interesting to note that we've actually cut back quite significantly on our tactical asset allocation activity this year. We took the view that in an environment which was sort of characterized by uncertainty rather than risk, there wasn't really much value that we, or I suspect anyone, could reliably, consistently, robustly add through short-term TAA. So we've pulled that back in. But the long-term journey plan, the de-risking triggers, I mean, so they don't change. I mean, that's the path that we're on. And I don't think now is the environment for people to stray too far. Sorry. I don't think this is an environment where I would want to stray too far from strategic asset allocation for exactly the reasons I mentioned. If you don't have confidence in the ability of TAA to consistently add value, then stick to your strategic asset allocation. That's far more important to us than short-term market views.
Okay. Yeah, it's in a way, my question was almost referring to that you see a bit more trends emerging, like, for example, in property, we were talking earlier about logistics benefiting more from the current COVID situation, and it might be obviously across equities as well. Demand for party dresses has probably decreased, and some examples.
Yeah, but I think I'm a firm believer in the value of investment processes that are based on bottom-up views rather than imposed top-down thematic views. You have a much more resilient, stable investment base to work on when the portfolio is built around hundreds of little decisions rather than imposing sort of 4 or 5 big macro calls on it. And I think particularly on for longer term investors, it makes not just those a longer term time frame, but those a longer term holding period. It makes more sense to make a large number of stock specific decisions and allow your portfolio to gravitate towards growth areas in that way, rather than necessarily seeking to apply some sort of thematic approach.
Okay, interesting. And so let's talk a bit about your responsible investment strategy. BA Pensions prides itself on being quite an active shareholder, with the 1/3 of your portfolio is invested in. Oh, is that a dog in your background?
There are 2 joys of working at home. Yeah.
Very diligently. Yeah. That's good. Right. So where were we? Responsible investment. You pride yourself on being quite an active investor on your equity side, active shareholder. Can you give me some examples of recent shareholder engagement?
Well, I mean, clearly over the last couple of quarters in particular, a lot of our engagement has been driven by COVID-19. So the PMs have been spending a lot of time dealing with or engaging with investee companies to make sure we understand how they're being impacted, but also how they're dealing with their stakeholders, such as employees, customers, suppliers, and to really sort of keep a clear view on how they're reacting, because I think that's key. You know, outside of that, we've worked with a number of mining and energy companies in particular to ensure that the industry associations that they're aligned with are in turn aligned with those companies' stated climate goals. I think in a number of cases, the industry associations that the energy and mining companies are funding are known for lobbying against climate action. Yeah. And clearly, so we think that this isn't appropriate for corporates who have themselves signed up to the Paris Agreement to align themselves with this sort of activity. So we've been working with companies on those grounds, and I think that we would also seek to be we also are active in ensuring non-executive directors are right for the boards they're going to join. We focus particularly on addressing the issue of overboarding. Our head of global equities, that's a key feature of him. I should say that, you know, the activity we run is done primarily at first level by the portfolio managers, whether it's in equities or fixed income and alternatives, and our stewardship and engagement activities then sort of pulled together, tracked, reported by the responsible investment team.
That must have been very different this year as well, because I presume a lot of the AGMs that took place this spring were online and probably required a bit more planning in ahead, or I don't know if that worked at it differently.
I think that I'm not sure. I mean, we wouldn't be attending most of these things in person anyway. So, you know, we're very active in voting, but that's all done ahead of time. So, yeah. I don't think our level of activity has been impacted by the change in working model.
Yeah. Well, that's a
maybe
good thing.
maybe the focus has more.
And how do you implement responsible engagement strategies across the other asset classes? Because you're obviously also quite significantly invested in fixed income and alternatives.
Yeah, so for corporate bonds, we monitor risk exposures at security and portfolio level, the same way as for equities. And again, as with equities, it's the PMs leading the activity on stewardship and engagement issues, and then we've got the RI team working alongside them, where we use third-party managers, for example, in alternatives. The focus is on understanding their ESG policies and processes, and then addressing the specific issues as they arise.
Okay, interesting. And so we talked a bit about the broader structural challenges for the global economy, and where do you see the key risks at the moment?
As before, the key risks, in a sense, haven't changed. As before, we've got a risk-free rate which is effectively negative. The risk-free rate has dropped much more than the likelihood of risks appearing has. So to that extent, risks are being systematically underestimated. I think that again, as before, I remain concerned that many financial assets, capital markets, are being influenced by huge short-term liquidity flows, and that the information content contained within asset prices, by definition, is therefore much less than it was. And I know that people a lot cleverer than I do sort of spend a lot of time trying to work out what the implied risks are in asset prices. But the point is that I think asset prices are telling us a lot less now about future prospects than they are telling us about sort of these huge liquidity flows that are hitting them. So that distorting effect is still very much to the fore in my mind, and I think we need to be able to almost turn down the volume on what financial markets are telling us and take a view on the long-term prospects of individual companies.
Okay, is it a good or a bad time for a value investor, or for a bottom-up investor? I should say you described yourself as such earlier.
Well, value investing is a rather different issue. For bottom-up investing, I don't think there's ever sort of there's ever a particularly good or bad time for that. Will bottom-up investing work over very short time periods or in momentum-driven markets? No, not particularly. But if you are a responsible, genuinely long-term investor, then I think that it is always the credible, responsible way to run a portfolio.
Okay, interesting. Now
we might want to change that. That sounded rather pompous, but yeah, we'll see how that goes.
Yeah, always in an interview, it kind of makes sense. In written format, it always looks very different as well. Just as a last question on your outlook for the global economy, what do you think the world will look like in a year's time?
God knows. David Lloyd George once said that the most dangerous thing in the world was to attempt to leap a chasm in 2 goes. And I think that 1 year time horizon, that is right in the middle of the chasm. So we know what tomorrow is going to look like. I think we can probably assume that what 10 years time is going to look like. 1 year's time, who knows? Will there be second and third waves? Almost certainly. Will there be more lockdowns? Personally, I suspect there won't be any more national lockdowns. There may be local ones. Will there be more government assistance across developed economies? Almost inevitably. What that gives us on a 1 year time frame, I've got no idea. I don't think that as a long-term investor, I'm too worried about that. And I certainly wouldn't be looking to make investment decisions at stock level or asset allocation decisions on that kind of time frame either.
Yeah.
So, you know, I say, you know, sort of, I don't know. The more accurate answer is, I don't think it's relevant for us within this fund.
Okay, so you don't know, but luckily you don't have to know. So let's wait and see, I guess.
Yeah, absolutely. We're going to find out one way or the other, aren't we? But I think that the implication of that is that we don't want to have directional bets within the portfolio at this point in time.
Yeah.
In an environment characterized by uncertainty rather than risk. You know, so we know the range of outcomes, but we don't know the probabilities attached to them. That is the worst possible situation to make directional bets on. And so what we're aiming to do is have a broadly diversified portfolio, and rather than making big positive bets, trying to avoid the nightmares and swamps out there.
Okay. Well, on that note, thank you very much, David. That's been really interesting, and it's been a pleasure speaking to you.
Thank you very much for your time.